NUCO can choose to set up a subsidiary instead of a branch. This is because certain tax benefits are not available to branches. Although branch operations are subject to income taxes similar to those levied on resident companies, branches generally are not eligible for tax incentives and must supply proof to income not derived from Malaysia. If a branch does decide to incorporate, it may not carry forward its existing business losses on incorporation. Commencement date started when NUCO manufactured goods. NUCO should commence its business during the financial year ending 31 December 2019. This is because if they delay the date of commencement, they will incur more expenses to set up NUCO. All revenue expenses incurred by the company during that year will be allowed for deduction as allowable expenses against the estimated gross income of RM1 million. Thus, it also will reduce the adjusted income. However, if NUCO chooses to commence the business during the financial year ended 31 December 2020, it will occur a lot of non-deductible expenses during 2019 that are not eligible for tax deduction. It will be considered as expenses incurred before the commencement date. The best incentive that can reduce tax liability after claiming investment tax allowance is reinvestment allowance. NUCO is eligible for the incentive due to it meets all requirements, which first, NUCO is the resident company in Malaysia. Secondly, NUCO had incurred qualifying expenditure for expansion of its manufacturing business. And lastly, it has been in manufacturing operation for at least 36 months. The company incurring more capital expenditure because NUCO plans to buy more machinery and set up a new factory building. The amount of reinvestment allowance is computed at 60% of qualifying expenditure and can be utilized against 70% of statutory income for 15 consecutive years of assessment.
Alright, we'll start our meeting today. We'll start with Miss Zila. Hi Miss Zila, could you advise Pharma on the disposal of its machineries in terms of timing?
Pamkas Neighborhood should dispose the old machine after 2 years of acquisition to avoid the clawback claim in previous years, and that will treat it as balancing charge in the year of disposal. Machine that generate balancing allowance should be disposed at the end of the year in order to shelter adjusted income, whereas machine that generate balancing charge should be disposed to the following year to defer tax liability. Therefore, Pamkas Neighborhood should dispose the old machine on 31st March 2020 to generate balancing allowance and deduct the balancing allowance against adjusted income.
Another question for Miss Zila. Could you also advise PAMKA on how to save tax on the disposal of the stamping machine?
Pamkas Neighborhood should dispose the stamping machine after 1st June 2021 in order to keep ownership of the machine 2 years, which is from 1st June 2019 to 31st May 2021, which is the minimum years required to avoid clawback. All capital allowance received in previous years will be clawback and treated as balancing charge if the stamping machine is sold before 31st May 2021. As a result, Pamkas Neighborhood statutory income will rise and its tax liability will rise as well. If Pamkas Neighborhood does not dispose of the stamping machine to an external party, but dispose it to a related company, the situation will be regarded as control transfer. Therefore, the sale consideration will be ignored in the computation of balancing adjustment. The disposal value will be deemed equal to residual expenditure. As a result, there is no balancing allowance or balancing charge.
Alright, we will continue with Miss Lini. Miss Lini, could you state whether Dharma Group of companies can make use of group relief to reduce tax liabilities in years of assessment 2020 and 2021.
As we know, Dalmur Berhad, which is an investment company, currently has 3 subsidiaries. Dalmur Berhad has 75% shares in Damsi Sdn Berhad, 90% shares in Pamtas Sdn Berhad, and last but not least, 80% shares in Rubas Sdn Berhad. A meeting had scheduled to discuss whether Dalmur Group of Companies can make use of group relief to reduce tax liabilities in year assessment 2020 and 2021. Before the conclusion is made, we went through the conditions of eligibility of group relief laws, which are: first, both claimant company and surrendering company must be a resident and incorporated in Malaysia. Second, claimant and surrendering companies each has paid up capital more than RM 2.5 million at the beginning of basis period. Third, both claimant and surrendering companies must have same 12 months accounting period. Fourth, claimant and surrendering companies are related parties for at least 70% of paid-up ordinary shareholding is either owned by surrendering company or commonly controlled by another Malaysian resident company. Fifth, both claimant and surrendering companies are not currently enjoying certain incentives such as pioneer status, income tax allowance, reinvestment allowance, and etc. Sixth, the claimant must have aggregate income in that year assessment. Seventh, both claimants must be subjected to tax full at 24%. Looking through the paid ordinary shareholdings, all 4 companies including Dalmur Berhad is a related party to each other. Unfortunately, Pamtas Sdn Berhad is a loss-making company with a paid-up capital of RM 2.3 million, and it does not meet with the one of the conditions, which is both claimant and surrendering company each has paid-up capital more than RM 2.5 million. Therefore, only Damsi Sdn Berhad and Rubas Sdn Berhad can make use of group relief, while Pamtas Sdn Berhad cannot make use of it.
Next, could you advise Ruba on the best method of financing its purchase of new machineries? And please state your reasons.
On the other hand, Rubas Sdn Berhad has come up with a business plan which involves purchasing a huge amount of new machineries in the near future. We came up with the best method for Rubas Sdn Berhad in order for them to purchase the machineries, which is a long-term loan method. This is because all the capital allowance will be based on the full cost of qualifying asset. Aruba will be entitled to claim initial allowance and annual allowance on the first year, and annual allowance for each subsequent years until the full relief is given for the qualifying capital expenditure. The loan interest will be allowed as a revenue expense deduction. In addition, if Rubas Sdn Berhad use this method when they purchase the machineries, they have the option to purchase and keep the machineries at the end of long-term loan agreement, not like the leasing method that the company need to return the machineries at the end of leasing agreement to the owner.
Wow, that's a good method with the relevant reasons. I also got requested to advise Damsi on which company should be taken over, whether TST Sdn Berhad or KY Sdn Berhad, and the method of acquisition. Damsi Sdn Berhad is advised to take over TST Sdn Berhad instead of KY Sdn Berhad, although TST does not meet the eligibility for the group relief as it is currently claiming its first year of pioneer status. TST will meet the eligibility next 4 years. Furthermore, TST Sdn Berhad also has a similar nature business with the Damsi Sdn Berhad. Hence, the 70% of the year business loss of a surrendering company can be surrendered to its related companies, which is claimant company, within the group in the next 4 years. Damsi is also advised to avoid TST through acquiring shares as the method of acquisition. A common shares purchase involves acquiring the business whole, which means taking on its assets but also its employees, its liabilities, and any legal actions outstanding against it. There are a lot of advantages when a company acquires through shares. Firstly, the major advantage of a straight share purchase is its simplicity. There is no retitling of various assets, and constant does not have to be acquired from existing client to continue contracts, as they are included with the acquisition, while acquiring the asset will have to be retitled. Besides, there are possible transfer tax benefits that arise in common share purchases, which do not usually arise in asset purchases. Next, the common shares purchases are usually an easier pitch to sellers than asset purchases. They do not want to be left with the downside any more than the owner does. Alright, we will end our meeting today. All of your performance was very good. Thank you for all of your cooperation. We will see in the next meeting.